Hello and welcome to this mineral exploration lecture series. Today I will be presenting my thoughts on mineral value chain and mineral exploration as business. My name is Amit Tripathi and I work for MPXG Exploration Private Limited, and we have been involved in several mineral exploration projects all around the world, including three major discoveries of copper, gold, porphyry, lateritic iron ore and uranium. Now, any industry has its own value chain. Uh, Broadly, it can be described as input, process and output, or in terms of manufacturing industry as raw material as their input, value addition as their process, and a final product that comes out of the industry. For exploration value chain, the concepts can be expanded to prospect exploration, detailed exploration, establishing feasibility, mining, processing, and mineral based industry. Now, progressively the value increases from here to here. Mineral based industries are larger businesses and tend to capture large portion of the value chain, while smaller business tend to be specialized. Uh, Out of the entire mineral industry value chain can be divided into three parts. First part is the exploration, which goes from prospecting to exploration, feasibility. Then it's mining, that takes up more detailed feasibility, actual mining and processing. Processing can be a bit overlapping between mineral based industries and mining. Uh, some mines actually process their product before selling, and some mineral based industries also process the input and before using it in their manufacturing processes. Now, since mineral based industries are capture a larger portion of the value chain, and larger businesses tend to look at their previous parts of the value chain as their captive business. Viewed from a traditional mining perspective, entire exploration is a captive business or a process, and the mining industry treats exploration as an expenses, not as an expense, not as an investment. Similarly, mineral based industry treats mining as a captive process. But exploration, prospection, exploration, feasibility, mining, processing, and mineral based industries all are and all can be independent profit centers and part of a larger value chain, where each industry produces raw material for the next industry in the value chain. To grow, it's important for each industry to have its own sets of regulatory framework to flourish, and every industry needs to be nurtured to adulthood. The basic regulatory requirement is the freedom to innovate, freedom to develop, and freedom to sell their products. Now, the primary product or the primary raw material for this entire value chain is a concession or a license area. Now, let's expand on the exploration value chain. The exploration value chain takes a unproven tenement as a exploration license. Uh, the industry processes are to prospect this license, explore this license, and prove feasibility of the license in form of a fully de-risked mining concession with proven feasibility. So a raw material of unproven tenement is just a piece of land gets enhanced to a fully de-risked mining concession which is economically feasible. In the process, the exploration value chain essentially enhances the valuation of this license. This is the space in which all mineral exploration businesses or junior mining businesses operate. This is akin to, let's say, as an example, could be a plot of land. Uh, a builder buys a plot of land, makes foundation, builds a boundary wall. The price of that plot of land increases more than the cost that he has put in into building the boundary wall. Similarly, once he makes foundation for the building, he starts selling the apartments, and as the construction goes up and up and up and nearing progression, the price of the apartments start increasing. This is exactly the concept of mineral exploration. To take unproven tenement, continue the process of de-risking to fully de-risk mining concession, and the value of the property goes up through the process. Now, how do we de-risk a exploration property? First step is obviously to identify what are the risks. Now, the risks are resources, whether sufficient quantity, sufficient amount of mineral is there in the plot of land. Metallurgy, that is whether this can be successfully extracted and the output product is metallurgically suitable to be used in the next higher level of value industry. How does the mining or the mining process, the planned mining process, affect the environment and whether it would be environmentally sustainable? Uh, how does the community react to it? There are two different aspects to that. The project needs to have a community on the project or near the project, so that the people who are working in the project can live there, can stay there, or can draw staff also from those communities. But at the same time, the communities, the project should not create any problems for the community, so that they don't turn hostile and against the project. Third is to study the market, the mineral or the commodity that is being mined through this, that is planned to be mined through this operation. What are the market projections? Are the commodity prices likely to increase or likely to reduce? Are there other mines that are coming online, increasing the supply, or mines that are going to complete production, reducing the supply? How are the demand productions, economic forecasts, etc. for that commodity? Then the cost. What's going to be the cost of mining? Resources can be there, but resources can be such structurally complex situation that extracting them would be very expensive and more than the selling price. Then that would not be feasible. Then the jurisdiction. Jurisdiction is whether the laws of the area where the project is situated are conducive to development of mining projects, or do they facilitate, or do they hinder, or there are certain issues within the law that make mining very difficult or impossible. Then infrastructure. Do we have roads, power, water, access to bring people in, bring machinery in, and to take the material outside? Now, de-risking strategies would be continuously de-risking all of these risks. Not one by one, but little work has to be done in all of them all the time. Now, the first work that we do is the generative part, where the companies that work in the generative field, they identify projects, they collect the historical data for that area, find out and map the artisanal mining, if there's something happening, small scale mining, illegal mining, tribal mining that is happening in that area. Then do a very detailed remote sensing study, field reconnaissance, and spot sampling. Essentially, within large prospect or within a reconnaissance area, there would be certain spots that would justify further investment or further moving ahead to the next stage. Now, the next stage is prospecting, where airborne geophysical works are carried out, a detailed mapping of the prospect is carried out, regular grid geochemical and geophysical surveys are carried out, trenching and target identification, Wildcat drilling is that after doing all of this work, we identify, let's say there are 10 or 15 spots that should be tested by drilling to see whether our projections are on the right path. And then after doing that, do a predictive modeling of what is at this stage our concept of what the mine could look like in 3 dimensions before moving on to the next step. Now, next step is the evaluation part, where a more detailed mapping is carried out, which is generally tend to be 1 is to 5,000 or finer, typically 1 is to 1,000 to 1 is to 2,000. Close grid geophysics, essentially focusing more on the third dimension. Uh, then this predictive modeling here is revised using the inputs from the detailed mapping and geophysics. Then a very detailed drilling with logging, sampling analysis is carried out, and an ore body model is created. Now moving on to feasibility study. Once we have this ore body model pretty much sorted out, or looks like that it's fairly large enough to be able to progress to mining stage, we do a beneficiation or metallurgical tests of the ore, test the infrastructure, conduct a environmental impact association, environmental management plan. So environmental management assessment and environmental management plan, social and community studies, market studies. We start moving the permit from exploration permit to mining permit, mine planning, production and scheduling, and detailed costing for capital expenditure and operating expenditure. Now, the generative processes are relatively cheaper, and as we move down the higher level of understanding of the project, of the property, the requirement of financing progressively goes up very significantly. Now, how do we address this financing issue? Now, typically, as we start on the early prospecting stage, it's friends and family. Let's get together, pool in some money, distribute some shares amongst ourselves, and do the first step. Then next step is the private equity funds that specialize in mineral exploration financing would look at the projects, would look at the teams, would look at the track record of the teams doing the work, and these are essentially just financial investors, akin to venture capital firms that are active in different parts of the economy. Now, once the project moves further ahead, typically onto exploration or body modeling stage, then we get larger funds involved. Now, it can still be at this point whether privately funded or publicly funded. At some point within this stage, the decision is taken whether to list the property on a stock market and raise more funds from the stock market to complete the exploration. Now, after this, the next option available is the stock market, unless a major miner gets interested into the property. So, getting the property ready and listing to stock markets, there are 3 stock markets all over that specialize in exploration financing. One is the Toronto Stock Exchange Ventures, TSXV, Australian Stock Exchange, ASX, and the Alternative Investment Market, that's AIM, based in London. Now, some point while the companies are listed and putting out public releases about their exploration successes, major miners who are actual mining companies, they have their exploration departments that look for that keep studying the stock market for different players that are coming through, and they identify the companies that have the commodity or the scope or the size of their interest, and they at some point do a deal with the smaller company and buy minority equity with an assurance of keep buying equity and gain majority stock by the time the project attains feasibility. And then these are the players that actually do the mining. Some of the minor junior exploration companies want to do the mining themselves and forego this step and start the mining industry also, mining production also themselves. Now, how the tools that are typically used for raising finance for the projects are discounted valuation. Now, discounted valuation can be said that, let's say, right now the face value of a stock is $1. Then we sell the stock for, let's say, 50 cents, 30 cents, or 20 cents, or even 5 cents, depending on how far we are ahead in our exploration plan and how the market responds to a certain commodities at what time. This keeps changing. Then private equity placements is that we take the projects, prepare presentations, and present them to private equity and the fund managers. Share sales, stock market, we get listed to stock market, we sell shares to raise money. Warrants and options. Then often we can do joint ventures with some other companies or other financiers that are active in that space. As we progress and larger funds of larger amount of money is required, and the feasibility looks like yes, it can be established very soon. Pledging of future production can be made for at a discounted price to raise funds for completing the exploration and development work. Then selling of royalty rights is also a useful tool. Even a project that is a early stage project can make a deal with a larger company, selling the rights to the project but retaining the royalty for future use. Then once the royalty is secured, the royalty rights can also be traded or sold depending on the fund requirement and needs of the company. And this is where windfall occurs. Now, funds, by the time, why would funds and private equity actually invest in such projects which are not economically viable or feasible, proven feasibility right now? Essentially, they get their shares, their hands in at a significant discount, and the companies that actually are performing well, these these investors can make a windfall profit. I'll show you some examples of the recent profits in the companies. Pacton Resources is an Australian-based company listed in Canada. In 2008, their stock price had more than 700% profits. Amex Exploration in 2019 gave 452% profit. Evrim Resources in 2018 gave more than 408% profits. So you can see that there are several companies that have shown windfall profits, and these are the companies that the private equity managers and the fund managers are interested in picking, and that they not only give them a huge boost in their profitability, but also hedge against some of the investments that do not get this kind of a profit. Let's look at some of the examples of outperforming juniors in 2018. These junior stocks have outperformed the TSX's Toronto Stock Exchange Ventures Index, Composite Index, by 700% in 1 year. Now, 2018 was a year where TSX Composite Index was pretty flat. But you see these companies here, PAC is given 715.38% profit within 1 year. Evrim Resources 412%, NMI 340%, Octo Resources 360%. Similarly, there are companies in 2019. 2019 was relatively less profitable year, but there have been companies here that have given more than 100%, 200%, and 300% profits in 2019 also. Now let's look at some of these companies and their business models, what they have been doing, how they have been making so much profit. Now Pacton Resources, as you see, this is a map of Australia, so Western Australia. So this company has several concessions in Western Australia. This is kind of a bit of a history for the of this company. Their first acquisition has been Melina Marble Bar property, which is 492 square kilometer property locating in Melina region, where gold nuggets have been recovered by Degree Mining, Carriers Resources and DGO Gold since late September 2017. So this property has been a coarse gold property where gold nuggets are found on the surface. Similarly, they have made 5 different acquisitions from 5 different concession holders and created a business that at this point of time has no resources, but the market cap is $63 million. The business model of the company has been value addition through exploration. So essentially they acquire prospects, unexplored or partially explored prospects, and invest into developing them to exploration level or feasibility level. So far, this is the financial outlook of this company. There's 91.2 million shares have been issued, market cap $63 million, 27.125 million warrants, and fully diluted 126,521,440 shares. Now, the assessment year for this that I studied has been from August 2017 to August 2018, and the share price has grown very significantly, giving 700% results to the within 1 year to the investors. The people who bought shares or who were holding shares on August 2017 made 700% profit in August 2018. Another company that would like to mention here is Amex Resources, Amex Exploration. This is TSXV, that is again a Toronto Stock Exchange listed company. 1 year gains is 452.38%. Current share price is $1.16 Canadian. There is also a gold and base metal company, and it owns the Perron Gold and base metal projects, the Eastman River Gold Properties, and Label Sur Quevion Gold Project. Another company from 2008 is Evrim Resources. Now they are working on the prospect generator business model. Prospect generator business model is the companies that directly apply for exploration licenses or prospecting licenses, do a little bit of work, data collection work only on the prospect level of de-risking, and they hold very large concessions or several large concessions, and they actually sell joint ventures, venture partnerships in these licenses. So this is the company these is called generative business companies. Now these companies, in addition to seeking joint ventures, also as a part of the joint venture deal, they keep some part of the royalties with them that they often sell to raise funds for their capital requirements. Next is Oroco Resources. Oroco Resources is actual exploration, is doing actual drilling and reserve estimation part. They have completed 106 diamond drills and reverse circulation drill holes, totaling about 30,000 meters. Now this is a copper project with copper project with gold and silver credits also, and the mineral recoveries have been very good, 86 to 96% recoveries. Now they are adding value. They are changing or revising estimates made in 1994, which are historical estimates by Mintech, and now implemented the 43101 standard, non-compliant, but done by competent professionals. So this is something that is on way for a larger excuse me. Now the 1 year profit of this company has shown 380% in increase in valuation. K92 Mining is again a Toronto Stock Exchange listed. KNT is the stock ticker. So in 2019 it showed 205% increase in the share price, the current share price being 257. Now this is an advanced project company. This is a gold exploration company, and its focus is starting the gold production from the Quara gold deposit, which is part of their Eastern Highlands province in Papua New Guinea. So the project is in Papua New Guinea, but the company is listed in Canada. So this is already started. It has already started production. It has done 18,000 ounces of gold, 209,000 pounds of copper, and 5,000 ounces of silver. From a regulatory point of view, why should it make sense to nurture the exploration business? Now, product diversification and mineral conservation, sustained supply and assured supply of de-risk projects to major miners. Now, major miners are our mining companies. In Indian context, it could be larger companies like Vedanta or NMDC or Hindustan Zinc or Hindustan Copper. So the junior companies would specialize in identification of the minerals, and through their efforts, through their dealing in this high risk space, they would ensure that mineral supplies, or the, let's say, mineral balance sheet of larger mining companies are fully stocked. Then mineral exploration essentially is a high risk business activity, so we don't want taxpayer investment in high risk exploration business, especially in base metal and precious metal space. Base metal, copper, lead, zinc, silver, gold space. Greenfield exploration, that is the prospect stage work to production percentage conversion, is in single digits. As we move up the value chain, or let's say move up the price chain, the exploration success is less and less. From greenfield to production for gold is definitely less than 1%. For other metals, copper, lead, zinc is still in single digits. That also means that on a regulatory, on a macroeconomic level, more projects actually fail than they succeed. So for a government, it's actually a good idea. Instead of putting their own money into exploration, they can create an environment where private equity takes that risk, and on a macroeconomic scale, more money gets invested in mineral value chain than will be repatriated. This makes perfect sense. It's a good idea. You get more money than ever goes out of the country. So it also makes perfect sense to make this space extremely open and easy, and it also provides a strategic independence. How does it do strategic independence? A country's overall strategic dependence on depends on its economy and its industry, and industries depend on the raw material supply for their sustained profitability. So having minerals ready for the mining companies to come and invest and develop is a major part of the strategic independence for any country. Now let's look at a strategic perspective in India. In 2000, these are the figures from IBM Mineral Yearbook, which is supposed to be the official document of mineral inventory in the country. Now exports, if we see iron ore, graphite, bauxite, chromite, and silver, exports show a sustained reduction, and imports show a sustained increase. That means essentially the industrial base is more and more overtly dependent on imports. Industrial base is getting progressively more import dependent. Not a good sign. Now critical industry supplies can possibly be disrupted in conflict situations. If there's a war and supply chains are disrupted, then the industry is likely to contract or even collapse. Now I don't know about what's the thinking in the Indian government that is happening at the moment, but the rare earths elements, which are critical components of many weapon systems. The production is largely dominated by China, and US government now deems bolstering rare earth production as a part of their defense strategy. Now, actually, in September 2019, President Trump issued a determination to Pentagon to encourage production of elements essential for national defense. I'm not at this point not sure what's the strategic thinking in India, but this is what happened in US. Now let's look at gold for a while. Gold essentially is the single reserve of value, is the psychological reserve for value for pretty much, and it has been for pretty much all the history that we know. Now, we had been expecting at the beginning of the year 12 to 13% gain in 2020 in the value of gold and the prices of gold. Now, this has become accelerated because of the coronavirus outbreak and global pandemic and decline of many industries. So a lot of investment has come out from these risky industries and gone into gold as a safe haven. Now, in January 2020, Ravindra Rao, who is the head of commodity research at Kotak Securities, said gold to test 1650 ounce dollar per ounce in 2020, but this happened actually in February itself. Now, 950 tons of gold, approximately 30 million ounces per year, is our import. That is, we import about 1000 tons of gold every year in India. So $100 change in the prices is equivalent to $3 billion of our spend in foreign exchange. In 2020, the prediction has been 200 ounces. So that's about $6 billion increase in our import bill. And with coronavirus pandemic happening in early 2020, this probably can become $400 per ounce. So that's about $12 billion increase in our forex bill. Not good. So the projected import bill at 1650 ounce would be $49 billion. Now this price, as we are discussing in May first week, is already crossed 1750. So which is already reached about half of our crude oil import bills. So this is just second to our crude oil import bill, and we don't use gold to drive our cars. We have to have crude. But if we have regulatory rationalization, this will reduce the import bill. Regulatory rationalization means permissions to explore and develop gold mines within India. So, okay, let's now look at how do we succeed in the business of mineral exploration. Globally, majority of companies who undertake mineral exploration and as standalone commercial business are known as junior miners or simply juniors. Now, juniors need a good property with mineralization in it, obviously not known at the time of acquisition of property, access to capital, and an experienced team. From an investor's point of view, how to identify a spot successful juniors? Small management, just 2 or 3 or 4 people, not whenever more than 5. Empowered field team. The decisions of exploration are to be taken by the people who are there in the field, not from the head office or approval seat to head office. Wastes a lot of time. The guy in the field needs to be able to take decisions. Distributed shareholding. This is the exact opposite of most businesses that tend to hold on to capital or hold on to control. In junior business model, we tend to distribute the risk and distribute the profit for as wide as possible. And the focus has to be a singular focus. Junior explorers cannot get distracted by trying to think of getting into production or other value-added products with singular focus on exploration success. So essentially there are four verticals to the mineral exploration businesses or junior businesses. First is the property, identified proper jurisdiction, or all the aspects of jurisdictional risks properly identified and addressed. What are the potential risks to mining, whether it is identified by the exploration team, infrastructure challenges, labor challenges, environmental challenges. They, they need not be zero at the time of property acquisition, but at least the teams, the management should be aware of what are the potential risks and should have a plan to address these. Then finance, you should have a very good CFO who is in touch with all the investors, proper bookkeeping, and brokers and analysts who keep an eye on how the project is progressing and keeps guiding the financial aspects and the technical aspects of what the market is expecting of the project. Then the technical team led by a good exploration manager, competent geoscientists who have experience in the style of mineralization that is being explored, a very robust database with very few errors, and a proper reporting format and the proper reporting of those results to the market. Then there are non-technical reasons, technical functions, essentially which is exploration camps, legal and liaison, social and community relations, and public relations. All these functions, or the functions heads, have to have a singular focus on enhancing valuation and de-risking. Continuous de-risking. Every decision that you take has to enhance the valuation of the company. Now the process flow sheet of the business is, first is identifying undervalued assets, then analyze from the financial perspective, technical perspective, and management perspective, can the company add value to this asset? If yes, then do a proper due diligence and negotiate with the property owners or take the concession. Raise investment from the same way, friends and family, followed by private investment funds, stock market, and keep adding value. So the valuation keeps increasing. At some point of time, decide that you can exit, either sell the property to a major company or sell or joint venture it to a company that specializes in the next level of exploration. Exit, raise some capital, and look for other properties. That is the business model for junior miners, junior explorations. Now the regulatory framework that nurtures exploration business worldwide is the right to procure the raw material in this case being exploration rights, time bound and predictable processing of applications. In India it is RP or PL. Then once you place an application, then you know that, okay, this application will be processed and the mineral rights granted within 2 weeks or 2 months or 2 years, whatever. It has to be predictable. The market does not like uncertainty. In most countries, most jurisdictions, there has been historical geological work or traditional geological work, either through geological surveys or through other companies that have explored the area. Then access to existing maps, existing data, and historical records is important. Predictable tax permitting regulatory framework. It's not low tax. Low tax is definitely good, but predictable tax is even better. So while even before starting mining in the exploration phase, where the actually revenues are still like 5 to 10 years away, we know what would be the taxes at that point. And again, predictable progression to mining rights. Let's say we have an exploration license or a prospecting license. We know what is the roadmap to obtain mining rights. What is the roadmap to obtain environment and forest clearance, water rights, access rights, land access rights, surface rights, construction permits, predictable taxation, import and export, and repatriation policies. Every jurisdiction has this different, but the jurisdictions that have it stable and predictable seek a lot or get a lot more in mineral exploration investment. Then the jurisdiction or the government needs to accept windfall profits. Essentially, the explorers are actually doing exploration within with an expectation of windfall profits. In many jurisdictions, the governments are let's say not, they don't accept. If you're making too much profits, essentially they think they're taking money, you are taking money away from them. So exploration investment happens with an expectation of large profits as a reward for taking large risk. Many places the investors in exploration business, they lose money, so they compensate that from the projects that actually are successful. So the regulatory mindset of preventing large profits through adversarial taxation is a big red flag for mineral investment, mineral exploration investment. Then this is a high risk industry and it requires a lot of freedom to innovate, technological innovation, develop and use cutting edge technology. Many jurisdictions are very afraid of new technology. They would say no, it's not allowed to do this kind of work or do that kind of work in our jurisdiction. So that's not freedom to innovate and develop. There could be genuine risks. So those risks have to be defined in the rules, and need to be predictable. Then there has to be financial innovation. Accepting windfall profit is a driver for high risk investment. Permitting valuation deals, share splits, consolidation, warrants, options, hedging, pledging, royalty deals, rental, leasing, collateral, partial sale, full sale of exploration properties should be permitted. Then marketing of the product. The final marketing of the product depends on what the investor deems as most profitable for their business. So blending of products, long-term export tie-ups, developing downstream industries for specialty products, all this freedom needs to be there. Right to market. Exploration industry products are value-added exploration or mining rights and NSR deals. Exploration industry products are not minerals. They are property that have been fully de-risked and with feasibility either fully or partially proved. Now, globally, these rights are acquired and sold through a series of joint ventures and ownership dilution through shares traded privately and publicly as exploration progressively adds value and requires more financing. The most important freedom has to be freedom to fail. At some point of time, we realize that this project is not feasible. You should be allowed to fail. Now let's look at what's an investment super cycle. An investment super cycle is a time period, typically 10 to 20 years length or wavelength, where the markets typically become bullish and bearish in the resource space. When the markets are at their bearish, no investment coming in, then all investment moves to North and South America and Australia. As the market condition improves, the investment comes into Asia. As it turns to optimistic and excitement and thrill, more investment goes into Africa. When it starts coming, start the bearish trend again, all capital exits Africa at this time, all capital exits Asia at this time, and everything goes to North America and Australia through the market thinking of fear, desperation, panic, regret, despondency, and depression. Then the cycle returns and continues. Historically, there have been several investment super cycles, and a lot of resources are available in literature to study them. Let's look at the current scenario. From the period 1995 to 2011 was one investment super cycle, where 2007, 2008, 2006, 2007 was the period where market was going through euphoria, Uh, Mineral deals were being done for projects that had no value, essentially for millions of dollars. They were selling for millions of dollars with no reports. Suddenly, in 2008 2009, the financial crisis hit, and very quickly everything just all the investment dried up, all the money moved back to America and Australia. Now, that was the crash that was happening between 2011 2018. Now, another interesting thing is gold prices often are an indicator of how the market sentiment market is behaving. The gold prices slowly go up during the period of the bullish period. The gold prices actually go very quickly up during the period of depression. Essentially, not because of the demand supply, but because larger funds that are holding billions of dollars, they deem gold as a safe investment. Then, by the time the market is going through the panic, regret, despondency, gold prices crash, and then again have a trend going up. So this is what we observe in the current scenario also. Now, what happened in India? Now, in India up to 1992, the mineral industry or exploration industry was pretty much under government control. All the major minerals were explored by the government and the public sector companies. In 92, liberalization happened, and in the 1992 to 1998 period was the golden period for Indian mineral exploration industry. All the large names all over the world, large companies and smaller companies, they actually came to India, set up shop here, acquired reconnaissance permits, and did a lot of high level, high quality exploration. Also met with some decent exploration success stories. Now these companies applied for prospecting license based on their results or successes of reconnaissance, and most of the state governments just sat on the files for 2 to 3 years periods without making a decision. So most of these companies actually essentially left, and since then they have, India has had a very bad name. The other regulatory issue we have here is the exploration industry is clubbed with mining industry. We don't have a separate law for exploration, and it's just the mining law which is applied to exploration also. So that what happens is mining again treats exploration as a expense, not as an investment, and not as a and so the exploration industry has not taken roots in India. It is treated as an essential evil that has to be done before mining can be started. So there's no profit being made in doing exploration in India. There have been a few notable exceptions. There have been a couple of companies called, one is Deccan Gold Mines, and another is Geomysore. These two companies have started off and stay on as exploration companies, but last few years have not been good for them. Lots of their applications are stuck, and they have actually made mineral discoveries and gold discoveries, and applied for permission for mining, but they are having a tough time. Second is predictable rules versus discretionary rules. Is that we know a clear pathway to success. We complete those formalities and the work will be done, or the concessions awarded. Versus discretionary rules is then when the government machinery and government officials actually can decide, all things being equal, that one company gets the approvals and the other does not. That creates a negative environment in the industry. Now, acquisition of exploration rights and selling of mining rights is still not fully and openly permitted in India. And the independence to use financial tools is also has a lot to be lot to be said. Now this is the suggested reading for this topic, and any questions we can take the questions by email or in comments. Thank you.